Hello, audience. Welcome to the Sense of Things. Another week of fun in the sun, another week of fun in the markets and economy. We found out about interest rates. Ron and I were on the button with what happened. So we'll talk a little bit about that today. Ron's got some fantastic information that he did some historical research about the markets and what's going on. We're at market highs in a lot of cases. He's going to talk about spinoffs today. We're going to talk about the dot plot. So all kinds of fun stuff to talk about. So stay tuned. We'll be right back on in just 1 second. All right. All right, everybody, welcome to the show. Ron, how you doing, my friend?
Good morning. Good. You only reduced it by 1/4 point and the world didn't end.
Yes. Yeah. Just the market went, whoa, wait a minute. We thought it was going to go to 50 basis points. And if it had gone to 50 basis points, the market would have gone down because it's too much.
I think if it went down 1/2 point, I think the market would have really sold off.
Yeah.
Because that would have been more of a shock than anything else.
Yeah. Like I said, I listened to financial media afterward. The market's down because the market was expecting 50 basis points and it was only 25. And oh, they're behind the 8 ball and all that. Okay, you would have complained no matter what. That's just how you guys work. The only thing that went up yesterday was the company that supplies Prozac to Wall Street at that point.
It's funny because now they're dissecting Powell's speech today and basically saying he's looking at other things that the White House is looking at, and so is the committee, and we'll talk about that in a second. And now people are thinking, are we going to get to more rate cuts? Look, they got to talk about something. I get it, but It was almost as bad as when they dissected Greenspan's Fed babble.
Yeah. Yeah. It's the same thing. Like I said, once again, it drives me crazy because somebody's going to be unhappy in any situation like that. So you've got some fun stuff to kick us off, right?
Yeah, and as a continuation, we got This Week in History. And
Nice.
I think next week is interesting, even if you did pay attention in school. The Constitution was signed in 1787. Here's the funny part about that. A lot of people are like, wait a minute, wasn't that signed in 1776? No, that was the Declaration of Independence. And I think a lot of people confuse the Declaration of Independence with the Constitution, no matter which political side you're on.
Like a lot. Yeah.
Think about it. We were building the framework of our country, and after the Declaration of Independence, it took 11 years to figure out the core framework of our country.
Yeah.
Anyway, I thought that was interesting.
Yeah, no, I think it is. And people don't realize how bad things were between the end of the war and that short period of time. It was ugly in the country and a lot of political dissent.
Well, it was rebuilding. There was a lot of parts to it. In 1908.
You had, that, you had the Federalist and everything else. Okay, cool.
Yeah, William Durant creates GM in 1908.
Nice.
Yes. He would be rolling over in his grave today if he saw his company. 1916. I thought this was interesting because I just saw something on the news the other day of Britain doing a documentary on this about tanks being introduced into warfare. And if you ever saw what the original tanks looked like, they looked like the little alien vehicles. They were like really compact with a little turret. Interesting.
Actually, and I didn't realize this, I would have been there in a heartbeat. Somewhere in London, it was during this week when Trump was going to England, they did, I guess because of this tanks introduced into war in 1916, there's actually a tank museum somewhere in Britain, and it had all the ones that were in Indiana Jones, the original World War I tanks and stuff like that. They have a whole bunch of them in this museum. So next time I go, I've got to go see this.
Definitely. Just in case anybody cared, this was the anniversary of Marilyn Monroe's skirt scene that everybody's very familiar.
Or shirt scene.
And a lot of men have tried to duplicate since. 1957, Nevada is the site of the first ever underground nuclear explosion.
Wow.
And I think they did one almost once a month or a couple of times a month after that for 10 more years.
One of the most interesting museums I've ever been to is the one in Las Vegas, the Nuclear Museum in Las Vegas. It's pretty bad. It's scary, but it's interesting. But yeah, they have a video where they show you like that area where they tested, and it looks like the moon. It's just all these sunken craters and stuff. And
the casinos back then, when they knew when they were gonna blast off, they used to have like parties and have these things where people would come and you could view it from 20, 30, 40, 50 miles away. So they have these viewing parties.
Yeah.
So this week, 55 years ago, Jimi Hendrix
died. Probably the biggest shame
I didn't
ever.
know this. This is before he was president. He files a report on UFO sighting.
Interesting.
I did not know.
Well, he lived in Podunk, Georgia, so they only ever go to Podunk areas. They never go to a big city. So
of course not. 1976, NASA unveils its first space shuttle, and if people remember, in 1979, it was used in the James Bond movie Moonraker. 3 years before they had an official launch of the space shuttle.
Yeah, which is pretty cool.
And of course, here's another anniversary we want to forget. 17 years ago, Lehman Brothers declares bankruptcy.
September of 2008, one of the toughest months I remember being in this business.
September 15th.
Yeah.
Crazy. Okay, here we go. Let's get into it. We're going to have some fun here. I snagged this at the end of the day yesterday from Jim Bianco. He had posted it on LinkedIn. So the dot plot, to explain it, and then I'll let you give your thought. So the people that aren't used to what the dot plot is, basically it's a Fed member survey. Each member says, what do you see for projected rate cuts this year and in the upcoming years? And I don't even know why the upcoming years means anything, because data changes month to month, quarter to quarter. Who cares what they see 2 or 3 years from now? But I think what was interesting is they're trying to figure out who this person was here. I think we all know who that was. It's the new Fed member. Thinking that there was no way they were going to cut this far. So I just thought this was I just wanted to get your thoughts.
Yeah, no, it's interesting. I like the farther out version where you see them scattering out a little bit, but that tells me, okay, it's in line, or most of the Fed's kind of in line with what you and I have been talking about, because you hear on the news, it should be at 3%. And I think that number in between 3.5 and 375, that was what we discussed last week. That's probably the neutral number at this point. I don't think 3 is even remotely realistic. And I certainly don't think 4.5 or between 4 and 4.25 is realistic. I think it needs to be lower, because we are seeing a lot slowing down fast. And
thing he identified, who the hell is the person that thought we get a rate hike?
We get a rate hike. It's what are you smoking?
But I think this is interesting. Actually, this is 6 dots, but these members here didn't think we'd get any cuts.
Yeah. No, it's just, we're going to leave it the same. Okay, let's just keep.
But this chart is always overanalyzed too, because this is trying.
Let's just keep fiddling while Rome burns. Let's keep fiddling. Yeah, or so some of them are now. You see them switching as you go into 2026. It looks like we'll have rate cuts into 2026. But yeah, it's what's the one smoking that thinks that they need to raise them this year?
But if this is where we are now, look at next year and how many people think we're going to get 1 to 1.5% rate cuts for the year. For next year. I think this is more interesting and compelling, knowing that this is 12 plus months out.
Yeah, that tells me that it's very likely for the next 6 to 8 months, we're going to see a 1/4 point rate cut every month that they meet.
Yeah, again, data dependency. All right, here we go.
This is good stuff, though. It's interesting information, because it's good to see where they're thinking.
Yeah, so look, we hear this all the time. Bubble, valuations, this, that, and the other thing. And I like this chart here, because here are a lot of the valuation ratios that people will use. PE, trailing PE, CAPE a lot. I like CAPE a lot. Even all these good stuff. Market cap to GDP, a lot of people look at that. And I think it's looking at all of this. And I thought it was interesting. You go back in history, the 2 biggest, let's just say, peaks in the market that people remember are 1929 and 1999. And here we're above that. What are your thoughts? I don't know. I think
and once again, anything can be manipulated and everything else. But I think it's a reality check. I think some of the, especially when you look at some of the stocks that are in, let's say, the AI space, I think the advantage that we have this time is, yes, we do have high valuations, but different from 1999, which a lot of those wild valuations that we saw were companies that weren't making a dime at all. A lot of the valuations we have today are companies that are actually making money, which is good. They actually have real profit. It's just, it's getting stretched. And I think it's not out of the ordinary or anything that I would say would be a bad thing of saying, hey, we might see a bit of a pullback here. I mean, there's, I think, a lot of economic data coming out, and I hope the Fed keeps going as far as cutting interest rates, because it can get really scary if we get too far into this and then all of a sudden it throws us into a recession or something.
I agree. To be determined. All right, next one.
Yeah.
This is a quick chart. Goldman Sachs put this out. I heard this stat the other day that Nvidia's market cap is bigger than the entire London Stock Exchange. And this is, yeah, you can say anything you want about our country and our economy and our markets, but this is way out of bounds. This is just insane.
Yeah. Yeah, it's amazing. Yeah. And yes, I hear people talk about you need to have diversification and international and all that. But the problem is, I look at this chart and I go, but why are they not catching up? It's just, why are they not catching up? Even you look at China as basically 6% of the world's global equity at this point, yet everybody talks about, oh, it's the world's largest economy and everything, or behind us, the world's largest economy. Yeah, but it's 6%.
Right, but I think the reason why, to answer your question, is because the top 10 stocks that are leading the world and everything is on the S&P 500.
Yeah.
And right now, I just heard it, I'm sure you've seen it too. The top 10 stocks are now 40% of the S&P 500. That means the other 490 make up 60%. And it's not like the top 10 stocks aren't profitable. They are by leaps and bounds.
Yeah.
But holy crap, if you're in the market for another 20 to 30 years, why would you have your money anywhere else if you weren't looking to diversify? It just doesn't make any sense. And the run's not over yet, but it's going to come to an end some point.
Oh, it will. Eventually, these things will step on their own toes or whatever, and we'll see it pull back. But for the foreseeable future that I can see, I just don't see it slowing down, or I don't see the world taking over and rebalancing this as far as I can see in the future. I benchmark against the S&P 500. I've got to stay pretty much in the game here. I can't afford to slow down my performance by having other stuff that is just not performing.
And the funny thing is, some people said, if I follow this model, you should have 25% international exposure. And I'm like, look, I'm all in for diversification. But prior to this year, why don't you compare the European market and the UK market to our market over the last 10 or 15 years?
Yeah.
You would have made 50% of the money.
Yeah.
Yeah. Okay. All right.
Totally agree.
I thought this was interesting, kind of just looking at earnings, right? For 90 years, since 1935, it's pretty much traded in a channel. And I think this is interesting, other than a hiccup here in 2020 and a hiccup here in 08 and 09, where we went out of that. This is, don't forget too, post 1990 is when ETFs were introduced. This is when also the first real 401k was in 1982. So you got to look at, it took about 10 years for it to get more adopted in more companies. So if you really look at post 1990, money is just continuously flowing into the market every pay period. So it's going to push the market up. Whether or not they're going into the funds are in good companies or not is another thing. But the funds diversify people, which is why we've only seen a couple of major swings.
Yeah. And the other argument, I remember when people would talk about when the baby boomers start to retire, then, you know, they're going to have to diversify into bonds and things like that. Bonds have been lost money basically for the last 10 years. They've performed absolutely atrociously. So you haven't seen that switch. Part of that was the Fed keeping interest rates basically at zero, for way the hell too long. But bonds have been an awful investment for a long time, and a
Well,
terrible income investment.
for income, more recently it's worked, but here's the difference too. A lot of the baby boomers that were invested in the market in the last 10, 15 years made more money above and beyond what they were going to need at retirement. So they
Yep,
still have a portion that's invested in the market.
absolutely.
It's not 100% converted to income. It may
No,
be 70, it may be 80% that's only converted to income.
yeah. Yeah, and I look at it from that perspective. The old game plan of you switch over into a bond portfolio and you draw income off your bond portfolio, it just hasn't worked. And us as managers, we've had to work around that. And the stock market's been a better investment for that time period. And quite frankly, if you look over it over time, I think regardless of where you're at, you should still have a pretty significant chunk of your portfolio, even in retirement, in the stock market. Because if you don't, you're just going to go flat, basically, and it's not going to keep wandering up. Yeah, it's not always the most, it's not just a straight line up, but you can see it's a straight channel up over time.
I just want to point out three very quick things on this, and we'll move on to probably my two favorite slides in this presentation. But if you take a look at when the EPS just went above its area here of out of bounds in the channel, we
Yeah.
followed the recession.
Yeah.
Right? 81, 99, 07.
Yep.
You're saying it just can't be tied, can't be 10 stocks. All right, here we go.
It could happen. Yep.
So, you know, what prompted me to find these charts, and I'm glad I did this one and the next one, is because I was telling people for years GE was dead money. I said the
Yep.
only way GE is going to make any money is if they break up the company. They did, and some of those pieces have just absolutely done well. And then here we got about less than a month ago, to Warren Buffett's dismay, Kraft Heinz is now, after they put it together, now they're going to split up. And this was interesting looking at this, that the amount of spinoffs is near a decade high. But a bigger chart here is this one. Because people say, look, you're going to do better. We were having a conversation pregame about 45 years ago when they were forced to break up. They all did well, and then they figured out, wait a minute, oh yeah,
let's put them all back together again.
But hey, maybe if we put a couple of these pieces back together again.
Yeah.
But I thought this was interesting because the S&P 500 has done well, but the companies that spun off have done well, but not as well.
Yeah. Yeah. But I think you get back to the point too, that anything can be manipulated here. Yes, the spinoffs haven't done as well as the S&P, but the S&P has done extraordinarily well because of a very small segment of stocks that have kept pulling it up over time. If you were to take out those top 10 stocks from the S&P index, I'd venture to say that it would have underperformed the spinoff.
That's exactly what I was about to go, because this is only a 10-year chart.
Yeah.
So obviously you had a divergence here in 2019, 2020, but you're right. Take out those top 10, I bet you the spinoffs. So it's still, I still think you want to look at a spinoff, you know, of a DuPont. Remember, DuPont split into 3 companies. 2 of them aren't doing that great, stock price wise. But again, you could probably
sometimes it's a good thing to split some of these things off, because those were dragging your company down, and you can get that out of the mix, and hopefully the main company can do well.
The whole part about our merger is not just to expand maybe in markets that you may not have access to, or to strengthen the markets that you're in, but the whole idea about it is to get rid of a redundancy that's cost.
Yep.
Because that goes right to the bottom line while you're expanding the top line. That's the purpose, typically the purposes of a merger. To break it apart, now you're going to have redundancies again, unless you're creating a holding company that's going to take on a lot of that.
Exactly. Absolutely. Yeah, so it's interesting. Like I said, I would love to be able to take that chart and pull out those top 10 stocks and see what the rest of the market did in relation to that spinoff. The reality is it doesn't matter. You know, the S&P 500, I think, is the benchmark for the world. I've looked at different benchmarks of S&P versus Wilshire versus all that. And in the end, the most consistent that I've seen from a benchmark perspective is the S&P, and it is what it is. We've got to live with the fact that those top 10 stocks make up 40% of the index at this point. And it's not like they're 40, it's not like they're 10 stocks that aren't making any money and it's just hype that's pushing them up. They're continuing to make more and more money. And we're in an interesting time period where those 10 stocks are now starting to leverage and utilize AI and technology to make lots more money.
Yep.
So that said, who knows, but we're going to keep reporting on it every week. And Ron, thanks for putting this together. That was fantastic stuff. So folks, we're here for you every week. We do this stuff because of you, and we love your feedback. Please share on the YouTube channel, especially share your feedback. Love to hear from you. And as a result of that, make sure while you're there that you subscribe to the channel. We will see you back here the very next time.